Welcome to the week that was. We are diving deep into a week that, on the surface, looked like a complete crisis for Bitcoin. But when you look underneath, it seems like the long-term foundations were actually being poured deeper than ever. It's this classic battle between the charts and the fundamentals. So let's just set the scene with the pain. At the start of the week, Bitcoin just plunged. It went right below that really crucial $90,000 mark. I think it hit lows near 85,000.
That's right. It was a 5% drop in a single day, which is actually the biggest we've seen in a month.
And overall, we're talking a retreat of over 30% from that October peak of, 126,000?
Yeah, exactly.
So our mission today is to look past that immediate carnage on the charts and really analyze this stark dichotomy. You've got the short-term chaos, leveraged traders getting completely wiped out, set against this unprecedented long-term institutional maturation.
Yeah, and what's so fascinating here is that we are firmly in what analysts are calling a high dispersion regime.
Okay, what does that mean in simple terms?
It means you're seeing two completely conflicting realities at the same time. So on one hand, you have these massive realized losses. Real painful selling, a lot of bearish on-chain signals. But on the other hand, you have whales, the big holders, just continuing to accumulate. You have disciplined professional capital buying every single dip.
So the battle isn't really the price today.
No. The real battleground is about who owns the asset 6 months from now.
Let's focus on that short-term chaos for a minute. I was honestly shocked by the numbers, the sheer scale of the pain for speculators. The price slide triggered this massive leverage purge. We're talking $539 million in liquidations.
In a single 24-hour period.
Wow. And that wiped out over 180,000 traders.
And it wasn't a one-off event, right? We saw another $500 million in liquidations follow later in the week.
So what does a leverage event like that tell us about the market psychology right now?
It tells us the market is actively, and I'd say brutally, cleaning house. It's punishing that speculative greed. And if you look at the technicals that triggered this, the charts were painting a very, very bearish picture. Not only did Bitcoin breach that critical $90,000 support level, but you've also got the death cross signal from mid-November still hanging over everything.
Hold on. For those of us who don't live in the charts, can you explain the monthly max CD turning bearish? What does that actually mean? Is it a huge red flag or just noise?
No, it's a significant warning. The monthly moving average convergence divergence, or MACD, turning bearish for the first time since 2022. That suggests the long-term momentum is actually reversed.
So not just a dip, but a potential trend change.
It could be. And psychologically, this translated immediately into widespread fear. The Bitcoin Fear and Greed Index just plummeted down to extreme fear. We're talking levels around 20 to 24.
Which historically can be a buy signal for people with a strong stomach.
It can be a powerful contrarian signal, yes, but the immediate risk is still very real. Analysts are watching that $89,000 to $90,500 range like a hawk. That is the critical defense zone. It's where you have a confluence of support, including the 200-day moving average.
And if it fails there...
If it fails decisively below that, well, that likely puts us on a path toward what some are calling the max pain zone. That's around $81,000 to $83,000. And that's where massive clusters of leveraged positions are just waiting to be liquidated.
Okay, so the market flushes out the speculators. But volatility, as we know, cuts both ways. We did see that sharp V-shaped recovery midweek. It popped back up to 93,000. What caused that sudden bounce?
That was a classic short squeeze. It's a pure market mechanic. As the price started to recover, it just forced anyone betting against it to cover their positions. We're talking somewhere between $196 and $226 million in short bets getting squeezed.
So this whole deleveraging process, while it's incredibly violent, it ultimately sets a healthier base.
Exactly. It removes all that speculative froth and makes the foundation less fragile for the next move up.
So that explains the internal market mechanics, but what lit the fuse in the first place?
We have to look internationally, right? Specifically at this challenging mix of news coming out of Asia.
Yeah, that's where it started.
First, you had the Bank of Japan, the BOJ. They came out with this unexpectedly hawkish tilt. They hinted at a potential rate hike in December, which immediately puts pressure on dollar-denominated risk assets, like Bitcoin.
And then you add China to the mix. The People's Bank of China reaffirmed its crackdown, no surprise there, but they explicitly vowed to ramp up enforcement. They even went so far as to call stablecoins illegal, which had an immediate ripple effect on crypto stocks listed in Hong Kong.
And this uncertainty wasn't just in Asia. Over in the U.S., Fed Chair Jerome Powell basically said a rate cut is, and I'm quoting here, far from a foregone conclusion.
Right. He used that analogy of driving in a fog, which is poison for risk assets. You saw traders just slash the probability of a December rate cut almost overnight. It went from nearly 90% down to 67%.
And this is where it gets really interesting because it leads to a central question about what Bitcoin actually is.
Exactly. We saw the U.S. private payroll data come in negative, a contraction of 32,000 jobs, which signals recessionary risk. Normally, that kind of bad news would send the NASDAQ down, and Bitcoin would just follow it right off a cliff.
But it didn't. It stabilized in the low 90,000s.
So if Bitcoin is this digital gold, why did it just stabilize? Why didn't it skyrocket on that bad economic news?
Well, I think that's the macro bullish divergence starting to show itself. It suggests the market is slowly but surely starting to see Bitcoin more as a hedge against, fundamental monetary instability and less as just another leveraged tech stock.
So less correlated with the NASDAQ.
Potentially. I mean, you have analysts like Arthur Hayes arguing that regardless of these minor rate tweaks, the U.S. Treasury will be forced to print colossal amounts of money to fund its deficits. If the economy weakens, the printing press goes into overdrive, and all that new liquidity has to go somewhere. It will flow into hard assets.
So the market is pricing in the long-term failure of monetary policy, not just the Fed's next move.
That seems to be the argument, yes.
Okay, so while the central banks are driving in their fog, the real long-term story seems to be happening on Wall Street. This is the big counterweight to all the chaos.
This is the invisible gate opening.
I mean, let's talk about the Vanguard news. That's massive. This is an $8 trillion asset manager, the fortress of conservative investing, and they just reversed their ban on trading third-party crypto ETFs.
It's a huge signal. When Vanguard, the gold standard for long-term, low-cost indexing, gives the green light, they are granting legitimacy.
It tells a conservative investor that this is now a permanent asset class.
It fundamentally changes how they have to measure risk in their portfolios. And at the same time, you had Bank of America's Wealth Management Division come out and formally recommend that high net worth clients allocate up to 4% to crypto.
Not as a gamble, but as a diversification tool.
Exactly. This is conservative institutional guidance telling their clients they might actually be irresponsible not to have some exposure.
And we're seeing that commitment reflected in corporate treasuries, too.
Absolutely. Strategy Inc., the biggest corporate holder, announced they've set up a $1.44 billion cash reserve.
Why is that so important?
Because it's designed to cover 21 months of their operational expenses. It means they will not be forced to sell any of their 650,000 Bitcoin during dips. It acts like a corporate price floor.
And this stability is getting support from governments, too. Even central banks are dipping their toes in.
Right. The Czech National Bank launched a $1 million test portfolio with Bitcoin and other digital assets. And they specifically noted its low correlation to their traditional holdings. That's a huge validation of the entire hedging argument.
Beyond that, we're finally getting some regulatory clarity, which is what everyone's been asking for. It's the ambiguity that's the biggest threat.
Exactly. And you saw the UK enact the Property Act of 2025, officially recognizing Bitcoin as personal property.
That sounds small, but that legal certainty is crucial for custodians, for insurers, for everyone.
It is. And then across the world, you have Japan planning to slash taxes on crypto gains. They're replacing a punitive rate that could go up to 55% with a flat 20%.
That's not just a friendly gesture.
No, it's a direct incentive to unlock a massive pool of domestic, corporate, and retail capital.
And all of these structural changes they've fundamentally altered the market, haven't they?
They have. And we have the data. Bitcoin has absorbed roughly $732 billion in new capital this cycle, driven almost entirely by the ETFs. And crucially, that institutional depth has resulted in realized volatility dropping by nearly 50% compared to previous cycles. This is not the same fragile asset it was a few years ago.
Which brings us to this historic decoupling we're seeing. For the first time since 2014, Bitcoin and the S&P 500 are moving in opposite directions for the year. The S&P is up 16% in 2025, and Bitcoin is down 3%. That is a massive divergence, and it really puts the whole digital gold narrative to the test.
It does, and the on-chain data confirms this shift. You're seeing a huge rotation of ownership. We saw realized losses surpass $5.7 billion. That's a meaningful capitulation from short-term speculators, the classic weak hands selling out of fear.
But at the same time,
At the same time, the whales, the large holders with deep pockets, are accumulating at a record pace during this weakness. It's an inventory transfer from speculators to strong, long-term holders.
okay, that sounds fundamentally bullish. But let's look at the institutional flows right now, specifically BlackRock's IBIT ETF. It's kind of a proxy for institutional conviction, right?
It is.
And it recorded net outflows on 3 of 5 trading days last week, including the largest single-day outflow of almost $195 million. Doesn't that suggest that institutions are just here to trade the volatility, not provide real stability?
That is the critical litmus test, and you're right to highlight it. Until IBIT returns to consistent inflows, it does suggest that institutions are using these price bounces to reduce risk, not to accumulate more.
So that $94,000 to $95,000 level is a pretty solid ceiling for now.
It seems to be a formidable ceiling, yes. Institutional money is deep, but it's disciplined. They are not panic buying here. They're still trying to calculate where the bottom might be.
And while all this is happening with Bitcoin, we're seeing the maturation of the broader ecosystem. Franklin Templeton filed for a spot Solana ETF, ticker SOEZ, and they're waiving the fees.
Which is basically a land grab.
Right. It validates Solana as a potential third pillar for institutional exposure, right behind Bitcoin and Ethereum.
That diversification signals market depth. But we also have to acknowledge the new long-term threats that come with this kind of technological advancement. New research from Anthropic revealed that advanced AI agents can now autonomously find and exploit vulnerabilities in smart contracts.
So developers are now competing against super efficient, automated hackers.
Essentially, yes. And then looking even further out, you have the long-term quantum threat. It's not an immediate risk, but the consensus is that Bitcoin's current cryptography could eventually be broken by quantum computing.
So the transition to post-quantum crypto is a necessary but probably decade-long project.
It's on the horizon.
Okay, so let's tie this all together. The week was just defined by these extreme contradictions. You had macro headwinds from the BOJ and the Fed battling structural tailwinds from Vanguard and Japan cutting taxes. You had price failure on the charts, but whale accumulation on chain.
And you see that tension in the commentary. You have Michael Burry calling the $100,000 valuation worthless, comparing it to tulip mania.
And on the other side, Ripple's CEO, Brad Garlinghouse, is predicting $180,000 by late 2026, assuming key U.S. legislation passes.
Right. So our strategic takeaways, really distilled from all this, focus on time and positioning. First, patience is key. Grayscale research suggests the old 4-year halving cycle is breaking. They're projecting new all-time highs might not arrive until 2026, not 2025. This implies the volatility we're seeing now is a mid-cycle reset, not a full-blown crash.
The growth trajectory is just getting longer.
Exactly. Second, avoid leverage. The market is actively and violently punishing it, as we've seen. Spot holding is the most prudent strategy. And third, focus on utility. While we in the West often treat Bitcoin as a speculative asset, its adoption in emerging markets, for remittances in Africa, for energy monetization, that reinforces its fundamental use case. And that provides a key non-speculative price floor.
You know, the market this week really feels like a super tanker. It's bolstered by these huge institutional inflows, this deep liquidity. It turns slowly, and it definitely feels the swell of macro policy, but it has a kind of structural stability now that allows it to plow through choppy waters that would have completely wrecked it in the past.
I think that's a great analogy. We've seen the price struggle to hold $90,000 this week. Yet long-term holders are buying, and Vanguard is opening its doors. And that raises a really important question for you, the investor, to think about. Given that the U.S. national security strategy just signaled increased and inherently inflationary spending, and with U.S. debt climbing past $38 trillion, is Bitcoin's current failure to immediately act as a definitive hedge a structural problem with the asset? Or is it simply a sign that the market is still waiting for the full implications of that debt crisis to become a tangible reality before it truly embraces decentralized scarcity?